Okie dokie. So tonight we're going to start with our second lesson in, what's kind of been dubbed the ultimate trading guide. Last week we talked about some trading sequences and stuff for people that can't sit and watch it all day. And actually, even if you are somebody that can sit and watch it all day, I hope you took something from it because there's a lot of pertinent data in that. This week we're going to talk a lot about something else that's really important to me and other traders here that trade options, and that's the options chain. Can everybody see my option chain up here on the screen? Okie dokie. There's a whole bunch of different stuff that you can put on your option chain. And we're going to talk about what that different stuff is and whether or not it has anything to do with you. Actually, Dan, it was December 1st. 12-1. Anyway, looking here, the stock we're looking at is actually irrelevant. And a lot of people will open up an options chain and it's all Greek, pun intended, because of the Greek values, delta, gamma, theta, Anyway, what we're going to talk about a little bit is which of these columns you actually need on here and which ones you don't. Sometimes having too much information, kind of like your charts, if you got all them little squiggly lines all over the place, but you don't know what to do with them, indicators is what I'm talking about, you end up not knowing what to do. They shouldn't be on your charts. Same goes for your option chain. There's a lot of people out there that they put a lot of weight on the Greek values or on, different things in general with it. But in all honesty, a lot of this stuff actually doesn't matter so long as what you are trading is something that is appropriate for the trade you're trying to make. What do I mean by that? So long as what you are trading is appropriate for the trade you're trying to make. What do you think? What do you think I mean by that? Anybody? Well, let's put it this way. An analyst report comes out this morning saying they put a $61 price target on Twitter, TWTR. Is it appropriate to take this week's $61 calls if you're trading for that analyst's $61 target? As a matter of fact, from what your price started at today, if you actually did believe, if you were convinced that that analyst knew what they were talking about and Twitter was going to $61, how far out would you probably want to be on something like a $61 call when Twitter started today at like 37, 38? When you're talking about the stock needing to double for you to go in the money, off at least a year, maybe two. And then there's that argument of, man, I could buy a whole lot of $61 calls on Twitter really, really cheap. Well, yeah, if you're buying the weekly, and then the worst thing you can ever do for an options trade is see the stock go up, be in calls, but lose money. That sucks when that happens, doesn't it? And inevitably it'll happen at some point in time, but we try to limit the occurrences of it happening. That's an important part. We want to limit the occurrences of that happening. Some people think that If they can buy a whole lot of contracts really, really cheap, then that's a good idea. Because obviously if you own a whole bunch of something, you could make more money. I used to think like that, and then I actually learned how to trade, and I don't think like that anymore. As a matter of fact, many times it'd be better to own one contract that you pay $2 for than it would be to own 8 contracts that you buy at 20 cents or 25 cents. And I know that old penny stock adage comes in where the thought process, yeah, but if that 25 cents goes to $2, yeah, but if your stock makes a $5 up move and your 25 cents goes to 0, that could suck. So right now in my options chain, I hope you're not trying to copy down my options chain because much of it could be irrelevant. But I wanted to discuss a couple things. You'll see me put out option alerts and, for example, I'd say something like AAPL 26 120 calls. And what that would mean is I'm trading the apples the ticker. The expiration date is 26 and the strike price is 120 calls. And a lot of people will be like, which one is that? I'm using TD Ameritrade. Well, there's 2 really easy answers for that. If I give you a contract that expires on a Saturday, that's the monthly. They expire the 3rd Saturday of every month. Everything else expires on a Friday. If you look at a calendar, you'd see that 2/6 is this upcoming Friday. 2/13 is next Friday, so on and so forth. TD Ameritrade will actually list it a little bit differently. You see, like my top one says Feb 1, that's first week of February. Feb 2, that's second week of February. They also make it easy because the gray ones, those are the monthlies. John, I don't know. I don't work for TD Ameritrade. I don't work for them. Scottrade doesn't either. And I don't work for them either, so I don't know why they don't. But what they do use is the options code. And if you're one that, doesn't know that February 6th is this coming Friday, which is the first Friday of February, so you're unable to realize that Feb 1 is the first Friday of February, then you could also add the options code. Like if I were to alert March 20th, Apple calls, the options code, you can see it is written out as AAPL, that's the ticker. 15 is the 2-digit year, 2015. 03 is the 2-digit month for March. 20 is the 2-digit day for the 20th. The C is for call. If you look over on this side, they all have P's for puts. And this one says 110, 110. That's the strike. So just as a little bit of a trivia, if I were to give you, if you use TD Ameritrade or Scottrade even, and I were to give you an alert that looked like this, what option code would you use? It's Apple 417 120 calls. What options code would you use if you were trying to figure out what it was to buy? It wouldn't be 07, Marie. It'd be 17 there at the end, but yes, you're in line with the option code. And Trini, you put the C on the wrong side of the 120. It'd be period AAPL 150417C120. That's the equivalent to the Apple April 17th 120 calls. Okay, everybody following me so far? Now, if you want to add stuff on your options chain, you come right over here to this little box, or wait, this box, and click Customize. There's a whole bunch of stuff you can put over here. If you're somebody that, you are able to identify that February 6th is the first Friday in February, then you might not need the option code. Take it off of your options chain, clean it up a little bit. Now, we're going to work here kind of from the center on the call side. The bid and the ask. What are the bid and the ask? Regardless if it's looking at the options chain or a level 2 for a stock. When we talk bid and ask, what are those? Well, the bid is what somebody's willing to pay. There's somebody willing to pay that bid price, or else it wouldn't be on the bid. And the ask is what somebody's wanting to sell for, right? It's very, very simple. The bid is what somebody's willing to pay. The ask is what somebody's willing to sell for. When we talk about a spread, like if you hear us talk in the chat room and said, oh, the spreads were awful on Goldman Sachs calls this morning. Still wish we would have chased them, but they were awful. What do I mean by that when I said the spread is awful? Or it's got a good spread? I'm not talking about like a spread trade. I'm not talking about iron condors, butterflies, any of that kind of stuff. There we go, Margaret. The difference between the bid, what somebody's willing to pay, and the ask, what somebody wants to sell it for. And the reason that can be important is when there is a large spread. If you go and snatch it up on the ask price, and then it immediately turns around and you're forced to sell it on the bid price, you could take a bit of a hit. You're right, Sam. Goldman Sachs is notorious for having wicked spreads at times. I know that deters most people from liking to trade a stock like that, but that's the chart I learned how to trade options on, and I'll never give it up personally. But as far as what the spread is, it is the difference between the bid and the ask. If we're looking at an options chain, do you think it's going to be pretty important for us to have the bid and the ask on it? Absolutely. We obviously want to know what people are wanting to buy it for and what people are trying to sell it for. The next column here is volume. This is different from a stock per se. You have two different things with an options chain that actually, and let me kind of put them close together real quick. Two things with an options chain that actually have to do with volume. One of them is called volume. One of them is called open interest. Are you confused yet? How do they both have to do with the volume? Does anybody know the answer? What is the difference between volume on an options chain and open interest, even though they both really have to do with the volume? Stephen is correct. The volume is today's volume, today's transactions. For instance, these 110 calls I have here, the volume today was 4284. That means 4,284 of these contracts were traded today. Tomorrow, that 4284 gets added to the open interest. The open interest is every day except for today. And it's important you understand it as every day except for today. And then tomorrow, that volume will start out at 0, and it'll trickle throughout the day. And the next day, tomorrow's volume will be added to the open interest. And it's consistent like that every day. The open interest is total traded except for today, and the volume is what was traded today. Why is that important? It's not so important to see if you can sell them, because most big board stocks are regularly traded. You're going to have intrinsic values with a lot of stuff. But there are times where people that aren't very smart will see, like, holy cow, 6 times the open interest was traded today on something. And they think that means they should buy it too. When in reality, most heavy options volume is big money protecting something. They could be short in a position and buying calls to protect it. They could be long in a position, buying puts to protect it. They could be long in a position and selling covered calls. Since the expiration date was created, Tim, you see, like right now for Apple, the weeklies only go up till the 2nd week of March. Well, once they have the 4th week of March in there, all the open interest will be at 0. And then they'll start adding up and adding up and adding up. You'll also find that your monthlies in relation to your weeklies always have a higher open interest. Why? Why would your monthlies have a higher open interest than your weeklies? Yeah, I mean, it's pretty self-explanatory. Right now, there's stuff all the way until January 2017, right? Simply, they've been around longer. And they've put like 5 different weeklies on it at a time. So the weeklies get created throughout the process, and then they go away fairly quick. Where that January 2017, well, you know what? That's going to have some open interest on it by the end. So it's pretty self-explanatory just with what you can see on the options chain as far as the dates available. But your volume and open interest work well so you can see what's being traded today versus how it's been traded overall. And it's not always necessarily the number that matters. It's not like it has to be some super huge number. It's the relationship between the volume and the open interest. For instance, I actually know it for a fact. A contact I have that runs a large hedge fund, he sold his hedge fund's entire Apple position today. Why do you think he sold his entire Apple position today? Well, it has nothing to do with the fact that his average breaks down to about $64 a share. But it got to a resistance point, and 3,000 of the 3,659 $100 calls today is what he bought. How many shares is relative to 3,000 calls? $300,000. 300,000 shares times the 118.82 he got as an average share price is 35,646,000. That's a lot of money. That's dollars. But he actually still has the position. How does he have that position? Well, he's bought 3,000 contracts at an average of $1,850, which is $1,850. And he spent $5.5 million. Now, $5.5 million sounds like a lot of money, but in relation to what he sold, did he spend a lot of money? You see, his mindset was after the Apple earnings, it ran up and hit 120. In the couple days since, it's failed to break back above that point. He would reduce his risk by selling his position and having less money, 1/7 of the money, really. If you really look at it, it's 1/7 of the money in calls that were deep in the money. It's pretty safe to say $100 calls are deep in the money, right? Shoot, they expire in March and they're already just trading on intrinsic value, right? 1855 by 1875. That's intrinsic value because you're over 118. So the 18, that's part of the 118. 100 plus 18, that's where you get it from. So now what he's allowed himself to do is have less money tied up, give it time to see if it breaks the resistance point. And what do you think, what type of plan do you think he'd have if it broke the resistance point? There you go. He'll exercise his calls. He'll buy the 3,000 shares back at $100, which would just basically forfeit his calls. But what it did was it freed up a huge amount of money for him. So just because you see larger than the open interest, I mean, half the open interest was traded today in the $100 calls, March 20th. Doesn't mean it's because somebody's guaranteeing it's going to go up and they want to be in it for it. What it actually means is that he sold his shares, but he still wanted to be in it just in case, but he wanted to define his risk. In a way that does not have much danger. So the open interest and the volume are pretty important details for you. And it doesn't mean just because you see abnormal volume on a particular strike that you need to chase in after it. You know, I love watching CNBC on the Fast Money show before Mad Money. They always talk about options and this heavy volume. And then you look the next day and, you know, they give all this explanation of basically what this trader is saying is they think it'll go to this price. Actually, they could just be short, so they bought a bunch of calls just in case it goes up a little bit. Has nothing to do with the expiration day, not always, because very few options traders actually hold until the expiration day. The only time you should really be holding till the expiration day is when you have the intention of doing what? Exercising the contract. Whether it be exercising your right to sell shares with a put or your right to buy shares with a call. That would be the only reason you would still have it through the expiration. Otherwise, you're either going to be forced to exercise it or you're going to just forfeit anything it could be worth, which is stupid to say the least. So, open interest volume, important. Buying just because you see abnormal volume on a specific strike, not important. This next category, you won't see it like with E-Trade, but TD Ameritrade have it. It's the Theo price, the theoretical price. What do you think that means? Well, no, they basically use a formula with all the Greeks, the price of the stock, and say, hey, we think that this contract that's 1855 by 1875 should be trading for 1924. Right now, as you can see, it's pretty much trading at theoretical value or at intrinsic value. The theoretical value, the difference is saying, hey, there should be some premium on there because you still got 2 months till it expires, but there's no premium. When you can find one that's trading at intrinsic value, if you think it's going to go up and you find a calls trade that's a month or two out and it's at intrinsic value, that pretty much means you can expect the move on it to replicate the move on the stock, meaning stock goes up 10 cents, contract goes up 10 cents, right? And actually, you can use that to your advantage in a way of trading where you'd kind of be getting, you'd just be replicating the gain the stock gets itself. But let's think of that for a second. If I wanted to buy 100 shares of Apple, how much would it cost me to buy 100 shares at the closing price of $118.60? 100 shares times $118.60, $11,860. If Apple moved up $1, how much money would my $11,860 be up? $100. If Apple moved down $1 per share, how much would my 100 shares be down? Or my 11,860? Be down that $100. Now, for many people, to buy 100 shares of Apple, we've got some people in here that probably couldn't do it. And we've got some people in here that if they were going to break their portfolio down into 10% increments, 100 shares of Apple would probably be all they could do. Whichever one of those you are, it's irrelevant. But here's the funny thing. If I were to take a longer term investment in Apple and I bought 100 shares for my portfolio thinking it was going to go up, like we said, I'd be putting at risk $11,860 right now. If the stock moved up $1, I'd make $100. If the stock moved down $1, I'd lose $100. Let's just use these $100 calls, for example. They are deeper in the money, right? They're $18 and change in the money, which means they're not going to have a lot of effect of time decay. They're going to trade much like the stock does. Also, the fact that you can see that even though there's 2 months left on them, they're trading at the intrinsic value, which is basically your strike price, or sorry, your share price minus your strike price for calls. We took share price 118.60 minus 100, the strike. We have $18.60. What was the final trade on it? 18.60. That means no premium. Intrinsic value is not affected by time decay. If this goes down, it's because the stock went down a couple cents. If it goes up, it's because the stock goes up a couple cents. But you see, if this stock moves up $1, and I own this $100 call that the last trade was at 18.60, and let's say Apple goes up to 119.60, a $1 move, what am I going to expect to be able to get out of my $100 call? Which would mean how much profit? There you go, Stephen, $100 profit, right? How much of my money do I have to spend to get the same profit or loss that I would get owning those common shares that I'd spend $11,860 on? $1,860. And why is it that I'm kind of focusing on that one? Why am I talking about the $100 call and not the $130 call? Because it's trading at intrinsic value. It is, well, the other ones aren't in the money, but it's because it's something trading at intrinsic value. There just happens to be a strike right there in March that if you believe Apple could go up, it would actually be your best buy. Your safest buy for sure, right? As far as options go. You know, if you buy the $130 call, if Apple really moves, yeah, you could make some money on it. But if it moves slow, yet still moves upwards, you could lose money on it. Especially if come March timeframe, it's not at $130. What percentage of that $11,860 would I have to put at risk to actually get the exact same reward? Well, let's see. Right now, the last transaction was $18.60. Each contract is relative to 100 shares. It's $1,860. If I divide that by the 11,860 it would cost me to buy the shares, and multiply that by 100, I'd be at about 15.5%. You see, the way options were actually intended to be traded was a way that you could trade without having the same money at risk while still getting the same reward. It's actually a way to define your risk. If you put this into perspective with a common stock trade and the amount of money in it, you wouldn't say, well, I've got $11,860. I can either buy 100 shares of Apple or 8 calls. That wouldn't be the way to do it. It would be to say I can buy 100 shares of Apple, but I could put a lot less money in it to buy just 1 call. I'd still have the right to that 100 shares. If it moved up, my contract would move up. If it moved down, my contract would move down. But I could not lose any more than 15.682967955952782% of what the common shares would cost me. Have you ever had a common stock trade that you were in that fell more than 15%? Even though maybe your plan was to get out at a 5% loss or a 10% loss, have you ever owned a stock and it fell more than 15%? In this particular case, you could trade Apple if you believed it would go up and guarantee that you could not lose more than 15.68%. Do you see how you could make that guarantee to yourself? Well, buy one contract for every 100 shares you would have bought instead. And doing it that way, what I call options in lieu of common shares, is doing it in a way where you can put less money at risk, but you also get like a ticket to a time machine. What do I mean by that? You see, a call is also designed to give you the right to buy 100 shares at that strike price. So let's say in the event of between now and the expiration, Apple goes up to 150 bucks. Would you like to own shares with an average price of 118.60? Yeah. If it only goes up to like 120, would you like to own shares at 118.60? Not really, probably. You know, what I'm trying to get at is many times people will look through a bunch of charts and say, oh, I think this one will go up, this one will go up, this one will go up, this one will go up. Okay, now I only have the money to play like 3 decent sized positions, and I hope I pick the 3 that go up the most, right? That's kind of like the average Joe starting out stock trading, where they see a whole bunch of stocks that could do something, and they hope that the one that they buy is one of those ones that does it. Pretty simple to understand there. Well, options kind of allow you to take a little chance at more things, and then you get to go back later and say, hey, it did it. I want that one. Have you ever looked at a chart and said, I think the stock will go up? You come back 2 or 3 months later, man, I wish I would have bought that one. Through the use of call options, you could put very little money in it, come back later and say, man, I wish I would have bought that down there. Oh, wait a second. I can, that option, that contract is like a ticket to a time machine. Let me call Marty McFly. Let's get the DeLorean warmed up. Because you can go back and buy it. We did that, actually, it was like the first week we started this chat room back in August 2012. I had bought Yahoo $27 calls. I spent $1 on them. I bought them for January of 2013. Well, a month before the expiration, Yahoo was at $50. Do you think I wanted to own shares at 27 when I only spent $1 on the contract, which meant my average was 28? Absolutely, I wanted to own shares. Guess what? I got to go all the way back in time, and my account looked as if I bought them at $28. What this also lets you do, when you talk about proper diversification, you don't want to get too heavy in a single sector. But if you're left going, okay, I like Yahoo, I like Apple, I like Facebook, I like Twitter, or let's just make it even more simple. I like Twitter, I like Facebook, I like LinkedIn. But if those are all I have in my portfolio, I'm not very well diversified. But I'm going to use one position spot. And I'm going to buy enough calls to get whatever my position size would be in each one of those three. And whichever one runs the most is the one I'm going to own. Yes, Sam, you have to be able to pay for the shares at that price. But you can also invest in options long term and just buy and sell the contracts, still using in the money contracts, trading it just like the common stock. And you know what? When those $27 calls, when the stock went up to 50, those were worth $23, and I spent $1 for them. They were worth the same amount of move that the stock got. I could have just sold them and made the profit. I decided to exercise them, own the shares, and then start writing covered calls, buying puts to protect it in the down move. And then I got stupid and sold my position. I don't know why I did. I made it free in a month after owning the shares. But if you look at options as a way to smartly trade stock, then all of a sudden you get like this whole different scenario. And I want to explain it like this. Let's pretend you're somebody that shows up at Stupid Nova. You got $3,000 in your account. Mr. Stock can't analyze nothing. Tells you, oh yeah, 3 to 5 positions is all you need to do with that. If you got a couple grand and you're doing like 3 positions, let's say you're putting $500-700 in a position, right? So we'll think of a stock that might be traded over there. Let's go to one like, let me find the chart. There we go. Let's go to one like AMD. If you thought AMD could go up from here and you wanted to buy shares, and let's say you were using like a $500 position size, how much money could you, or how many shares could you buy? $500 divided by 276, 181 shares. And if you showed up there with your $2,000 position size and you bought this one, and let's say they even put it out. Let's say you were over in Jason Bond Picks and he said, hey, I'm going to buy AMD for a long-term swing. So you put your $500 in it. How much money do you have left out of that $2,000 account? $1,500, or just 3 positions, right? You can only make 3 other trades. Have you ever been at one of those places like, well, I bought this and we're just holding it forever, holding it forever, holding it forever, holding it forever? Oh my Lord. You might have felt that way here before. Well, you see, here's a cool thing that somebody with that $2,000 account could do. They could come over here to their options chain and they could say, well, they think AMD is going to move up. I want to give myself a little bit of time. We'll give ourselves July. It's trading at 276 right now. I could buy 181 shares. Each call is equivalent to 100 shares. I'm close enough to 200 shares that, I could either spend my $500 on shares or I could put just $100 in it I could buy the July 2015 $2.50 calls. Probably somewhere, the last trade was 51 cents. Let's make the math easy. If they were 50 cents each, how much money would you have to spend on those calls? $100, and it would be like you had 200 shares at 276. That's a $552 position. But the big difference is if this trade works out great, it's going to work out and you're going to get rewarded for it. If your 200 shares made $1 a share, guess what your calls are going to do? What do you think your calls would do in the money calls if the stock went up $1? Anybody got a guess? They'd go up $1 too. Because they're going to trade on the intrinsic value. So if the shares go up to, let's say, $4, you're going to have that same dollar move in your contracts. And now what you spent for $100, or you bought for $100, is going to be worth $300. If you buy 200 shares and it goes up $1 per share, how much profit did you actually make? $200. If you bought two in the money calls for $100, but the shares go up $1 a piece, how much money would you have actually made? $200. But yet you didn't have to have the same amount of money in the trade, correct? You did not have to put $552 into common shares right now. So this can be beneficial even to those of you that are part of other services or may go to other places. And you got a smaller account and you're like, man, last night I was looking at 10 charts. 8 of the 10 did exactly what I thought it would do. I bought the 2 that didn't. You ever been there before? And usually you didn't buy all 10 because you didn't have the money to buy all 10. Does this give you a better chance of having the money to buy all 10? When options were introduced by the SEC in 1973, they were actually intended to be traded in this way. A way that you could still invest, but have less money at risk in case the market crashed. The money spent would react just as if you'd have spent a larger amount of money. With the overall goal, the reason they attached it being that right to buy shares at the strike price, the overall goal of if your stock moved well enough, you would want to own it, and therefore you would own it. Because let's face it, if I've got a $2.50 call, and I buy that now, and come July 2015, this thing's at $6. I'd make a pretty good return if I owned it at $2.50, right? I wouldn't have a lot of risk, even if it went down some. It could go down a lot before I actually lost any money, which would make me more likely to buy it or to keep it. And I would then own the shares. Then if the market crashed, I'd have plenty of time to get out before I lost money on my shares. So it was actually one of the few things the SEC's ever done with the small investor in mind. The funny, ironic thing with that is Americans are greedy and they want instant gratification. And they realize that the way these options are programmed to work, they're more volatile than the stock is. If you're trading the in-the-money calls, your stock goes up $1, your call goes up $1. If you're trading the out-of-money calls, you can get all wicked and crazy, quicker money, but also quicker losses. And we've steered away from how they were intended to be traded, but still trade them within the guidelines that are allowed to be traded. But if you trade options in the way that I just discussed, it's actually a safer way to invest, safer than owning the common stock. Could you agree with me on that, or do you have a question as to why I made that statement? Anybody? You see, a lot of people get scared of options because, hey, we're looking for quick volatility. We're trading way out of the money because they're cheap, cheap, cheap. And, if it goes up and we're in calls and we can get some money, great. But man, if we're in calls, out of the money calls, and it goes down, what happens to our out of the money calls when it goes down? Let's put it this way. We've got some $200 and $205 calls in Goldman Sachs. It's gone down over the past couple weeks. Today was a big up day on Goldman Sachs. Did it do anything for our calls? Other than the fact that for a little while I saw a bid of 1 penny on one of them. But the stock makes a $6 move and we're just too far out of the money. We like that extra volatility and that, that craziness when we're right on direction, but then it starts to give a sour taste to people when they're on the losing side. It's like, wow, I can lose money really quick trading options that way. But if you're one that wants to look at building your portfolio, well, you can build it with taking longer term calls that are in the money. And then after you give stocks the time to move, say, okay, now I'm going to go back and pick and choose which ones I liked best based on how much they moved. And those are the ones I'll own. And you can do it with very little money compared to the position size you would have had to buy. Or, like I said in my earlier example, if you're a part of another place where they say, hey, we're going to buy AMD because we think it's going to go up. And you're like, well, that's great, but I've really got to be picky with my positions because I've only got enough money to really make like $400 or $500 positions. And I want to make sure that they're the ones that are going to go really big, right? That's how you think when you're over in those places. I want to make sure that the one I pick is the one that's going to be the big one. How do you know which one's going to be the big one? When I bought those Yahoo $27 calls, I honestly had a target of $29 as a max. That was the highest target I could find. I went to 50. I didn't have some great big off the wall target, but it was a big one. When I bought my next Netflix shares at $70, I had no clue that it was going to go to 400 where I sold and now wish I still owned my shares. I thought I could double my money in a year's time. Well, Bill, that's exactly what that was a lottery trade. I could have either lost it all or had a big winner. And that's irrelevant to what we're talking about right now. So again, if you're one that's in one of the other services out there and you see an optionable security alerted, as in they're buying shares of AMD, just know that you can consult your options chain. Trade out. I mean, just as a general rule, go 6 months out and something that is in the money. You'll secure much less money into the trade, which does what? Gives you more money for other trades, right? I could do 4 positions at $500 each. I can do 20 positions at $100 each. And many times when you're in those rooms that are doing the lower price stocks, some of them aren't even going to be optionable. If they're on the OTC markets, there's no options. But if you're trading reputable company that likes to follow the SEC guidelines, any reputable company is going to be traded on a reputable market or in a reputable market. And then they will have options. You can trade those options in a way that allow you to secure less of your funds, but get the exact same gain as if you would have used the dollar amount to buy the commons. Getting back to the option chain and the last category we talked about, the theoretical price, the only time you would need this on your option chain is if you were unable to quickly say, what's my intrinsic value, and how much time do I have till expiration to kind of figure out what theta would be. But I will tell you this, they determine, TD Ameritrade with their theoretical price on the option chain, determines that price based on yesterday's numbers. Yesterday's delta at the close, yesterday's theta at the close, yesterday's gamma at the close, and then factors that in through all of today's movement. Have you ever watched those Greek values during the day? Let's put it this way. If you buy a call at 9:30, what's the odds that at 9:50 it'll still have the same delta value there? I won't say zero, but very low. They're constantly changing. So basically that theoretical price is kind of like a guess, but it's an educated guess. I will give them that it's an educated guess. And I think for those of you that are using Thinkorswim, to have the theoretical price there will give you an idea if it'll at least give you that feeling of if you're getting a good deal. I mean, let's face it, if this thing says I should pay $7.05 for the March 115 call and I can get it for $6.05, it feels like I'm getting a good deal, right? But that's about as far as I'd go with it. It doesn't mean, hey, let me go search through this, see every strike that's lower than the theoretical price, buy it, and then try to sell it at the theoretical price. Because the sad thing is if the stock moves up, you're probably going to sell way too early. If the stock moves down, you're never going to get a sell. So it's a good little way for you to compare what your prices are right now as to what an algorithm determines to be a fair value for you to pay. And in many cases, most cases, you're either going to feel like you're getting a really good deal or you're going to feel like you're getting shafted. And neither of those feelings will matter if you get the move that if you get an up move or down move and what these calls or puts would do. If it were me, because I don't want people to feel like, oh, hey, look at all these trading below the theoretical price. I would ditch it unless you find some value, maybe a ability to sleep at night because, oh, hey, I bought this at 18 bucks and this computer said it should have been 20 bucks. That's like going to iHub and reading all the penny stocks they say should be trading at $10 and you can get them at a fraction of a penny. Yeah. This next column is the implied volatility. What is the implied volatility? And by the way, if you're looking at your options chain in the morning, if you get a gap in either direction, you'll see the implied volatility going wacko. And it takes anywhere from 10 to 15 minutes to settle back down. And then start progressing in the direction that you're getting. But what would implied volatility be used for? Well, the definition of it, according to Investopedia, is the estimated, that's a key word, the estimated volatility of a security's price. So if you see how it's different for each one of those strikes, it's calculated for each individual one. You can actually run an implied volatility on the stock itself. It says in general, implied volatility increases when the market is bearish and decreases when the market is bullish. Unless you're in puts, then it would decrease when it's bearish and increase when it's bullish. Well, to me, that's just a common sense thing with options. Basically, it's a controlling factor of your premium. Puts are cheaper on a green day. Calls are cheaper on a red day. Going back to that conversation about using options in lieu of your common stock, if your common stock falls and hits your support point and you think it could bounce and it's a big red nasty day, you could secure less money in that trade to buy in the money calls and buy them cheaper than you would if you wait until the bounce day. Much cheaper, because usually the premiums will be sucked out of them on a big red day. As far as your regular trades, you can use that as well. If you're sitting here in the chat room during the day and you hear us talk about waiting, 10 to 15 minutes for implied volatility to settle down, leave the implied volatility on your option chain. Watch it. Watch it go all wacko at first and wait for it to stabilize. When it stabilizes, make your directional trade. The implied volatility, what is stable? When it's no longer jittering around between 17% and 65%. Quite literally. I mean, if you even watch your options prices in the morning, you might have an option open at 60 cents. The stock moves 10 cents, it goes to 90. The stock only drops 5 cents and it goes to 40 cents. Most of the time, right away in the morning is not the best time to buy options, because while that implied volatility is wacko, those computer systems that figured out what an option should be worth is going to give wacko results too. Very, very simple. If you're going to watch implied volatility, watch it to be something that stabilizes. Now, there are different theories with options trading that kind of, I guess you could say in a way, contradicts mine, where they give you these big formulas on how to calculate what strike you should buy. And they might say how you calculate, what's the word I'm looking for? It's on a sine wave. It's the steps out, and it's on the tip of my tongue, and I can't think of what it's called. If you look at a sine wave and you look at the little vertical lines for steps away from it. No. It's not phases. Standard deviations. That's the word, standard deviations. There are some that would say you could factor in the implied volatility to decide how many standard deviations you should be out for your strike price. I say use the average true range indicator, which is actually factoring in your standard deviations if you want to do that, if you're doing it that way. And if it says, hey, in a 5-day period, the stock moves $6 and you're trading out 5 days, make sure you're within $6. Simple enough. It's basically the same thing with a much simpler explanation that doesn't have you calculating a formula that takes a math whiz 30 minutes on a calculator to do. So very, very easy thing to understand in that way too. Your implied volatility, as far as options go, is just something where when you get gaps or quick movements, we'll go a little crazy. For those of you that day trade, you might be in a calls play, let's say, and like yesterday, the SPY shot up like $1 in one 15-minute candle. You ever notice that like during that 15-minute candle when it's shooting up, man, my option prices, they went from like $1 to $1.20. The next candle opened at the exact same price, but all of a sudden, even though the price isn't moving, my option is going back down. Have you ever seen that happen? You'll see it a lot with day trading especially. Or you'll break a resistance point, and when your price on that option might be $1, but when it retests that exact same price, even though it's just 30 seconds later, now it's 90 cents. It has to do with the fluctuations in the implied volatility. The implied volatility is basically how fast it's moving. Again, something that I think to most traders is, I won't say completely irrelevant, but confusing to the point where it doesn't need to be factored into your trades. This next column, Theta, T-H-E-T-A, Theta. What is Theta? What special word do we give it as options traders? Time decay. What is your Theta? That is the rate at which your contract will lose value on a daily basis. Does it mean that tomorrow you're going to lose 4 cents? What it really means is that tomorrow, if you open at the same price you closed at today, and here's the funny thing, and every other factor and value stays exactly the same, you would lose 4%. You might find that tomorrow you open at the same price you closed at today, and these are down at 320. You could find that tomorrow you open up at the exact price you closed today and they're up at 360. Here's the real reality of Theta. It's just a guideline because it changes too. But here's what doesn't change. For instance, we're going to look right now at the March 115 call for Apple. If I were to buy it on the ask for 605, how much of that 605 would be premium and how much would be intrinsic value? The answer to that is real simple. The current price of Apple is $118.60. If I subtract the strike price of $115, $3.60 is intrinsic value. That's actually what the contract's worth. Remember when we were talking about the $100 calls and I said they're trading at intrinsic value? So if we paid $605 and only $3.60 of it was intrinsic value, and then we factor in the fact that this has 45 days until the expiration, what you basically need to look at is over the next 45 days, that 245 will go away. And it'll go away whether the stock goes up or down. If it goes up, I may not notice it going away, right? If the stock goes up, I'm probably not going to notice that 245 of premium go away. Pretty understandable, right? Because if it goes up, my intrinsic value will go up, and I might not realize what I'm losing in time decay. But the reality is, I am still losing that. So I want you to remember that $2.45. And now we're going to go over and talk about the delta. Now, what's funny is in previous lessons, I talked about how the delta was a percentage move expectation for a single dollar move in the stock. And what's funny is that was actually correct at the time I was teaching that, even though 4 months prior to those lessons, brokers had already switched over to making it a true value. Which basically means if Apple were to move up $1, I would expect my contract to go up 65 cents. Does this make sense? That the delta is what I expect on my first dollar move. Is everybody with me? So if I pay $6.05 and Apple is at $18.60 and Apple goes to $19.60, a $1 move, what do I actually expect to see my contract go up to based on the current delta? $6.70. So are you basically telling me that no matter how long it takes, if Apple goes up to 125 bucks, 125 minus 118.60, oops, $6.40 move, that my contract will go up $4.16, and if I add that to my 605, I'll be able to sell it for $10.21. That's not true. You've also got to factor in that 245 that you're going to lose, right? So, you know, if we carried this till expiration day and it expired at 125, the stock price was 125. Well, that 245, we already know is going bye-bye. But see, this value wouldn't make sense either. Because there's 776, but if it's a 125 where the price is and it's a 115 call, I got to have something that gets me right about 10, right? Well, you see, that's where it can be confusing because that delta is always moving. The delta is always moving, but that's where the gamma comes in. You know, if we just took the delta multiplied by how many dollars it could move and forgot to subtract the time decay aspect of it, I mean, quite literally, it's a everyday calculation, isn't it? We've got 245 in overall premium. We've got 45 days until it expires. Obviously, as it gets closer to the expiration, the time decay has a greater effect, meaning it'll accelerate. That number will be higher. But you see right now, it's, you know, when it said 0.04, let me do this. I'm going to close out these July so it doesn't confuse anybody. Move this calculator right up to the one we're talking about. It's got that theta 0.04. Well, you know, if I just divided the total premium by how many days are left, yeah, I'm going to lose about 5.5 per day. Because that theta value always changes, because that delta value always changes, it'll be hard to get a firm calculation on the exact price you could sell it for in 3 weeks. If it hits the exact price target you picked on the exact day, and I'm sorry, if you can do that, I'm going to start paying you. So we have another little factor that we can help calculate in, and that is our gamma, the gamma column. You see what the gamma is like the delta. The delta tells us here's how much we should get on the first dollar move. So Apple's sitting at 118.60 right now. If it goes to 119.60 today, we'll be able to add 65 cents to our contracts. Tomorrow, we're going to lose a portion of our premium, the premium divided by how many days are left. But if it did it today, Apple at 118.60 now, if it ran to 119.60, we'd make 65 cents on the contract. If Apple goes to 120.60, $120.60, we take our delta, 0.65, and for the second dollar move, add the gamma. So we would make 65 cents, estimated, by the way, because the values are constantly changing, 65 cents on the first dollar move, and another 69 cents on the second dollar move. What if it goes to 121.60? We'd make 65 cents on the first dollar move, 69 cents on the second dollar move, 73 cents on the third dollar move. If it went to 122.60, we'd add another gamma in there. So the gamma is a multiplier for each dollar move after the first dollar move. And on that fourth dollar move to 121.60, we would take those 605 contracts. We would expect at 119.60 to be at 670. At 120.60 to be at 739. At 121.60 to be at 812. At 122.60 to be at 889. At 123.60 to be at 970. At 124.60 to be at 1055. But still having to go back and factor in how that $2.45 of premium decays away. So the easiest way I have found to use my options chain is when I'm studying at night and I'm like, you know what? Apple is actually right at a point where, you know, quite literally, I could pretty much get rid of any bearish argument if it breaks 118.85 and closes a 1 hour candle above 119 and a daily candle above 119. I can pretty much get rid of any bearish argument I could think of if it does that. Basically, if Apple moves 40 cents north, I'm not going to be able to, I mean, yeah, it could pull back at any time, but it's going to look pretty strong to me. So then when I look at that and try to pick a target on it, it's like, okay, in the short term, it might go to $120.13 based on my 60-minute chart. Well, I know I trade the following week's options, next week's options off my 60-minute chart. And at 120.13, a 120 call would go in the money. They're currently trading at 113. It's at 118.60. I would say, okay, here, let me scroll it up to the one we're talking about right here. If it starts at 113 and it goes up to 119.60, be at 151, cool. And if it goes up to 120.60, oh wait, it can't go up to 120.60 if my target's only 120.13. So then I kind of run into a mathematical problem. But I use that gamma to kind of factor in my after hours stuff. The reason I do that is during the day that delta is going to change anyway. And it's telling you the expected move if it moves $1 from right now. That's what it's doing. So in reality, I can take this, get rid of my gamma when the markets are open. And let's say Apple's at 119 and I'm in 120 calls and it says the delta's 40 cents. Well, if it gets to 120, I expect to be up 40 cents on where I'm at right now. If I have to wait overnight, I've got to deduct the time decay from it. And it makes it fairly simple. Is everybody with me on using these Greeks as just a basis point? And why I don't, because they're constantly moving, why I think that during the day you can get rid of the gamma, because your delta is giving you an expectation based on right now the current price if it makes $1 move. Is everybody with me? The other way this could really help you is, let's say you're in the calls and you say, man, this thing has run phenomenal. This thing's going crazy. But like earlier today, I had on my chart where it could pull back to that one W point or, 117.42. It bounced right off the W. They were within 10 cents of each other, the two target points. And it bounced off of it and started moving up. Well, let's say I would have been in calls when it started coming down. And then I start to look and it's like, okay, that's like $1.50 to the downside. I can quickly reference my delta and see what? For instance, if I was in next week's 120 calls, these ones right here, and I said, okay, it's made a nice move, it could drop $1.50. What do I need to look at? I know I'm at least going to lose 38 cents for the first dollar drop if I divide that by 2 just to go with a rough estimate plus the 0.38. Okay, this could drop 57 cents if it just drops back to the point I'm thinking it could pull back to. In the case that your option could move 57 cents, and let's say you're in calls, the stock drops that $1.50 and could still be bullish. Do you make the decision to sell it or hold it? And what factors would aid you in making that decision? And let's say my target was $120.13. I get up to a point where I'm like, this thing's making higher highs and higher lows. I think it could pull back $1.50. I'm probably going to lose 57 cents on those contracts, but I'm pretty sure that once it does that, it's just going to go up again. What would help me in deciding if I should sell it and buy it back later or hold it? What could help me in deciding that? What do you think? It's something that smaller accounts really have to focus on. Where a larger account, they might be able to sell it and the funds settle right away and they can just buy it again. What might I be alluding to? Well, not necessarily the pattern day trader rule, because I say all the time that if you're trading options, you don't need a margin account. In fact, you shouldn't have a margin account because of the pattern day trader rule on a margin account only that says you can only complete 3 same-day round trips in a 5 calendar day period. Not a week, it's a 5-day period. So if you do 3 on Tuesday, you got to wait till next Tuesday before you can do 3 more. People think that, oh, I'll do a margin account because when I trade stocks, if it's cash, it takes 3 days for my funds to settle, and I don't want to wait 3 days. With a margin account, it's instant. Well, with options, they settle the next day. So it would have to do with your whether or not you'd have settled funds. So if I think the stock could pull back $1.50 and it could cost me 57 cents, I now have to say, is it worth that 57 cents for me to maybe not even get to buy it? In the case of 57 cents on something that costs $1.10, well, it's probably worth it to sell it if it's going to lose half of its value. Wouldn't you agree? Probably worth selling if it's going to take a 50% hit. But you see, like, let's say you were in those 125 calls for next week. They're only going to lose 8 cents. Now, granted, that's 50% of the value. But if you start flopping around too much, considering that, you know, when your fees are factored into it as well, many times, especially for your longer term trades, your swing trades and such, if you start just day trading a swing trade position, you're left where you would have been better off trading the weeklies. But to use your delta in factoring $1 moves, it can be very, very beneficial to help you decide if you think you should sell it or not. Especially when you say, I mean, today, the first hour, or the first 30 minutes of the day, I said, watch Apple to come down either to that W point or 117.42. They're real close together. I think the W point, what was it? 117.59. So you had a 17-cent difference. I was positive it was going down. I didn't want to play puts because the chart's bullish. But I was positive it was going down there, and it did. If you're trading something that expires this week, next week, that big of a move, you kind of got to sell it for that big of a down move. But if you're trading out a month or two, I mean, you can see if I go with similar strikes over here, you know, if it moves $1, you're looking 27 cents, 14 cents. If you get to the point where the pullback that could happen exceeds the what if it keeps going up type of thing, then you're probably at the point where you should sell and not worry if it goes up. Sometimes people want, you know, well, I don't want to sell because what if it goes to here? But sometimes that can hurt you. Now, I will also tell you that me personally, I don't even have the Greeks on the my options chains. I don't even look at them because they change too darn much, and I like fixed data points. The next column that I have on my option chain is the net change. What is that? What is the net change? There we go. Some people, I thought somebody would say what it's up today, which is not right because it's what it's up or down in relation to yesterday's close. So you're very right there, Stephen B. Which you can see, even though Apple had a nice up move at one point today, almost all of your calls are down from yesterday's close, right? Can everybody see that? It's where it says minus and it's red. What's also funny is the same can pretty much be said about your puts too, right? They're almost all red. Now, why is that? Well, one thing would be that theta aspect, time decay. That theta wouldn't have really hurt the March monthlies. But you closed below yesterday's close, i.e. had a red day, which would theoretically hurt the value of your calls. But because you made a fairly solid up move and actually indicated a bullish chart pattern, your premiums were decreased in your puts. A lot of people try to put too much thought into options trading, when in reality, options trading is still something as simple as if you trade a strike that will go in the money according to your trade plan or your target, then regardless of what it does between now and when it gets there, I remember a trade I did back on, I think it was September, October in Goldman Sachs. We bought some calls. It went up $3. We were up like 200%. For 2.5 weeks, Goldman Sachs traded in a $1 range, between the high and low. We basically didn't move. I was still up $3 in common stock from where I bought my options, my calls. I went from being up a couple 100% to down 50%. Some people freak out and sell, and if you're trading a larger account, that's where you would sell and just buy again, sell and buy again. But for those with smaller accounts, trading specifically to target points and whether or not your chart's making a higher high and higher low, knowing that you really can't control when a stock's going to consolidate, but if you still have time and ability to hit that target, not so much worrying about the price of your contract right now today, would have you understanding why we held those for just another 5 days beyond that 2.5 weeks and made 300% because it moved $8 in a couple days. Now, if you were just trying to make your broker rich, you could have had several little trades in there. Pop, 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 pop. But ironically, the people that told me, oh, I just sold, I bought again, I sold, I bought again, I sold, I bought it. Then when it finally broke out, they didn't buy. Well, I missed it. And then it ran $8. Should your options trades ever be as big as your common stock trades? Ever? Absolutely not. And it is because options move up and down faster than the stocks do. Even if we go back to that example with the March 105 calls or $100 calls on Apple that are trading at their intrinsic value. If the stock moves up $1, let's see, we got 118.60. Oops, actually, let's do it this way. Let's go $1 divided by 118.60. Multiply by 100. That's 0.84% move for the stock. But if my 1860, oops, sorry, let's do it like this. $1 divided by 1860. That's a 5% move in my option. If I'm going to move 5.5% to every 0.8%, what happens if my stock does drop 10%? Then I'm going to take a big hit in my options, right? Even trading the safer way, you're going to have a bigger percentage loss or gain in your option. And people would say, yeah, but if it can gain more, I should trade it bigger. Those people go broke quick. You have to stick to smaller money in options, not because I want you to not make as much money, because you could lose more. When it comes to reading an option chain, you can make it as complicated or as easy as you want. Don't put data on your option chain, just like a chart. Don't put stuff on there you're not going to make a trade off of. Don't put data on your option chain that you're not going to use when factoring in a trade. That's why on my personal option chains, I don't even have the delta and theta. But I want to give one more example as to why a stock can move up and calls not go up, and why it's not always best to buy the cheapest contract you can find. And I'm actually going to use GS for it because I had some emails today. I don't understand how GS has moved up $8 since yesterday's low, and our $200 calls did nothing. Well, I'm going to explain that to you. Let's go right here to those $200 calls. What is the $200 call worth? What is its intrinsic value right now? $200 minus 180.25, the price of the shares, right? And actually, the way to really figure that out is take the 180.25 minus your $200 call. How much is a $200 call worth right now? Negative $19.75. Negative $19.75. So even if it's trading at 0 or 1 cent, what's the premium on it? If it is trading at 0, it's got $19.75 of premium. You might not see it that way, but that means that time decay is eating away at 19.75, not 0. Does that make sense? It's eating away at a value of 19.75. So when your theta says you're going to lose 1% per day, 19.75 times 0.01, you're going to lose 20 cents a day. And your delta is 3 cents. How far does this have to move to come back to really having any value? And actually throw out your theta, because if you've got $19.75 a premium and only 17 days till the option expires, you're losing $1.16 a day. How much does it have to go up just to stay the same price? As far as your contract is concerned, how much does the stock have to go up for your contract just to stay the same price at this time? Yeah, that $1.16. Now, our $200 calls, our 205 calls, those were made free with some puts positions. The puts positions we have right now aren't free. But, I'm not so much worried about those two calls plays, because we banked on some puts plays while we were holding those that paid for those easily. But understand that you have to move $1.16 just to eat your theta. Okay? Does that make sense? Okay, so today it opened at 176, closed at 180.25. We'll say roughly a $4 move, right? Roughly a $4 move. Well, why is the bid at 15 when yesterday there was a transaction at 7 cents? Let's see. The first dollar move, you made 3 cents today. The second dollar move, you see how my theta is actually, or sorry, the theta will be negative because that's what you lose. The gamma on this is pretty much non-existent. I don't have it up here. But the first dollar move, you made 3 cents. Let's just say you made 3 cents the second dollar move. Say you made 3 cents the third dollar move. And you got 3 cents the fourth dollar move. And actually, it wasn't even yesterday that there was a transaction at 7 cents. It's been a while. Your ask is actually above what would be reasonable, because just the move today took these things from basically 0 to 12 cents at best. Now it has to gap up $1.16 tomorrow and hold that price just to still be worth that 12 cents, because we have $19.75 a premium. Yeah, that's why I said a long time ago, they're dead to me. Once they were free, I stopped looking at them. It was either they hit my target or they're dead to me. But in all reality, when you look at your option this way, yes, when you're trading out of the money and they go in the money, you can make a much larger percentage on them and could have bought them cheaper than the in the money ones. But when they go the other way, you have much more risk. That's sadly just how it is. But to answer that, give an explanation as to why we moved up $8 from yesterday's low and didn't see a change in those contracts. It's because they're in the hole so far that even if they move up, Or even if the stock moves up, it doesn't mean the calls will. Which is also a great explanation of why you don't want to be too far out of the money. Now, if you relate that to something you might see day trading, have you ever been day trading and you're like, okay, the next strike out of the money is going to cost me $1. But if I go $10 out of the money on Apple, I can get that for like a penny. So I'll buy a whole bunch of those. And then it's like it moves $1 and you make a penny. Wow, I'm only at 2 cents. It moved $1. Well, I guess that's 100%. And then it moves up another $1 and you're like, okay, now I'm at 3 pennies. Sadly, I still haven't even paid my fees, my commissions, even though I just made 200%. But when it all comes down to it, you're going to get smaller moves in your contract price the further out you are, simply because of one other aspect. Look at your delta. What happens to your delta the further out of the money you get? What happens to your delta? Yeah. You may think it's better to take cheaper contracts, but taking the pricier contracts, you could say, well, I can only lose 1 cent if this thing falls $1. Well, you probably only have to pay 1 cent for it. So if it drops $1, it's just worthless. The sad thing is most people that would say that would also say, well, I can only buy 1 contract for $1 here, but I can buy 100 of these for a penny. I'm only going to lose a penny if it falls $1. Yeah. When you trade out of the money, you're running that extra risk. If it doesn't go your way, it's not going to be pretty. Okay, Leonard, but that still means you have to make 3 cents on every trade you do, right? So if you buy at a penny, 4 cents is your break even. Okay, so if you buy at a penny, trying to get the cheapies, you've got to make a 400% return to make any money at all. Not even worth it. So don't always get stuck thinking, well, I can buy these other contracts super, super cheap, thinking that that's the better trade. It feels like the better trade when it does go up and you make some money, but when it goes down, you lose more. That's why with GS, a lot of times I'm just, doing 1 contract. And even though there are times that I let a full 250 expire worthless, there's times also that 250 instantly, because I'm buying the single contract, instantly moves with the stock. Where like today, if you're too far out of the money, even though you could have got them cheap, you moved $8 from yesterday's low and the options didn't move because there's too big of a hole to crawl out of. They're not worth anything. I would rather have 1 contract at $2.50 than 10 contracts at 25 cents. The better trade will be made with the ones at $2.50. And on most things, not GS per se, because I'm a stickler on GS. It either hits my target or I don't sell. That's just the way I choose to trade it because that's the way I like to trade it. But for other stocks, if you're worried about, when can I get out and still have some value to those options? If you choose the 25-cent options over the $2.50 options, getting out is rarely ever worth it. By the time you've decided you need to get out, they're sitting at a nickel. By the time you sell those, you're just paying your broker to take them. Might as well keep them and see if they turn into something, right? And that's something important to understand because people get into that boat a lot. I actually had a guy yesterday. Bought weekly, what was it? It was Apple. Let me go read the email real quick. I'll put this over to Apple, and they were the weeklies for this week, and I want to say they were the 125 calls. Oh, yes. He bought 125 calls for this week when Apple made its W breakout, which yesterday was at 3:15. And the email says, Coach, I just noticed, or I was noticing today while I was trading, that from the W break on the 15-minute chart, and he attached a chart with a little arrow on it, that when I bought the 125 calls that expire this week, I barely got any return whatsoever. In fact, it wasn't even worth selling them, even though Apple moved up $1.50. When I look at the 118, the 119, the 120, pretty much any calls below the strike I picked, they all did considerably better. Please explain. My first response to him was this, real simple. I would like to get into depth on that, but first off, I would like to ask you why you chose that strike as the one to purchase. A couple hours later, response in the email. Well, I chose that because I could buy 100 of those instead of the 119 calls for the same price, and I wanted to make more money. My response, how'd that work out? His response, what do you mean? My response, the cheaper option is rarely the better option. Please attend tomorrow night's webinar so you can have a better understanding. Sadly, that guy's not here tonight. Pretty upset about that.